So, I was watching a hockey game the other night and I saw this commercial on TV from RBC. And it's kind of like the anti Quest Trade advertisement. And it made my blood boil because it's really preying on people that aren't sure about financial concepts and maybe don't know what to do when it comes to investing. And it's just so patently based on nothing and untrue that it's almost unbelievable. So anyway, here it is, and then we can talk about it.
Look how much money my investments made this year.
How come you're doing better than me when my accounts have lower fees?
I guess my advisor was right. Fees don't tell the full story.
Now, I understand that you only have 15 seconds for this commercial to get your point across, but it's what is being said here. Like, you're basing this on nothing. They're looking at a computer screen that you can't see any of the data on it. And she's got this smug look on her face like, haha, you sucker. I was with RBC and you were investing, by yourself, and I still made more money than you, even though I was paying crazy high fees that they're charging me. And it's not like this isn't possible. It's just that it's not the norm, really. Like, unless this guy what was he investing in that he wasn't able to do better than this other person with 2% head start? Like, maybe in 1 year that's possible, but over time, paying these fees to RBC for investing, it's almost never going to make you better off. So I was interested to see what would be offered here. So I followed the link. So I followed this link, visit rbcroyalbank.com, and it brings you to this site. And you've got performance, advice, and fees. So how your performance affects wealth. In order for your money to grow, your investments need to perform well. When you look at just fees without also considering performance, you may pay less, but you may also earn less. It's important to look at your actual investment earnings after fees. Here are a couple of things to consider. Now, this is so, like, the fact of the matter is, if you're a normal person and you go to RBC, do you think you're going to be getting the best financial advice on the planet, and they're gonna, just focus on you? Like, you're a number to them. Like, you're just another, unimportant, customer who's a bonus to who's ever signing you up to get them, get you in the door and start basically taking your money. Like, they're not doing this out of the goodness of their hearts. And it's completely disingenuous to say that, like, they can't make any guarantees that they're going to make you earn more money because of their good advice. Like you may pay less, but you may also earn less. Yeah. You also may earn more and also pay less fees. In fact, it's honestly probably more likely to happen that way. But, they're not going to tell you that because they're trying to, sign you up for their system here. So what is going on? Advice. Whether you want to buy a home, pay for your child's post-secondary studies, or enjoy a comfortable retirement, the value of having a professional in your corner can be priceless. Studies have shown that Canadian investors who work with an advisor, as measured over a specific time period, had almost 4 times the financial assets of investors who didn't work with an advisor over the same 15-year period. Well, I mean, I think a lot of honestly, that probably has a lot to do with the fact that generally people with large amounts of assets are financial savvy are more likely to have advisors, not necessarily RBC advisors, probably, better advisors. And like, what is the study even based on? Like, where's the study coming from? So you go down here and you got some nice bar charts. So 1 times to 6 years, 1.7 times with no advice. You're only getting 1 times. Like, what? Like, what does this even mean? Like, 3.9 times the money, I guess. Like, okay, like this graph is useless. It tells you absolutely nothing. So of course, I'm trying to figure out what this means, and it says at the bottom there, because they legally probably have to. Source: The Gamma Factor and the Value of Financial Advice by Claude Montmarquet, Natalie Briat, sorry for the pronunciation, 2016. Okay, so I go and look up this report, this fancy report. It's got, some nice graphics on it, and it's obviously from Quebec because it's all in French. And I skimmed through it a bit. There's lots of, fancy research being done here, but here's all you really need to know. Serrano is a private nonprofit organization incorporated under the Quebec Companies Act. Its infrastructure and research activities are funded through fees paid by member organizations. That's all you need to know there. Partners, I'll translate because you may not read French. It's corporate partners. BMO, one of the major Canadian banks, and I think these are some other Canadian banks as well. Now, Royal Bank isn't listed here, but I mean, this is all you need to know. BMO provides financial advice, and they've commissioned this report that says that getting financial advice is important. Is this useful? No. Like, you basically can disregard everything that's said in this report going forward, to be honest. Like, they're making money off of this report being beneficial to them. So like, the money's going back and forth. They're getting paid to get a report that makes the banks look good, and the banks give them the money because, they're going to get the report that they need. Like, it's garbage. It's garbage. It's not independent at all. So this graph is useless. Let's move on to fees. And here's where we get real down into the nitty gritty. Like all other things that offer value. Oh, this is, if you call them, this is the spiel you're going to get as well. They're going to really pour it on thick. There are costs associated with investing. Take mutual funds. They have a cost called the management expense ratio. It covers certain expenses, taxes, and services, including specialized investment management or expertise that can make all the difference, in bold, in how well your investments perform. So while every dollar saved in fees is a dollar that can stay invested, true, it's very important to also consider performance after fees and the value you receive. Oh boy. This is some Jedi mind trickery they're doing to people, and it's quite frankly it's disingenuous, and it's a little bit evil, because as I say, they're preying on people who don't understand these concepts, and they're just going to take your money. Believe it. I had a video here. I found one of these links back at, like, look at all this about the fees. Like, I'm not going to go into all this, but they have this cute little video to explain the fees for you. It's like, just listen to the nice, like, happy voice. Like, you're going to pay this fee and this fee. Like, it's all good.
It's important to understand the costs of investing, and when comparing options, it's equally important to understand the value you receive for what you pay. Let's take a closer look. The cost of a mutual fund is the MER, or Management Expense Ratio. Let's take a look at the MER for two different series of a mutual fund, Series F and Series A. Series F only reflects the cost of the fund itself. It's used in fee-based accounts, where your advisor charges a separate fee for advice and service.
It's really concerning how many times the word fee has been used already.
The MER for Series F includes the fee paid to the mutual fund company for investment management.
Look at all those people in suits you can pay. I mean, imagine how many vacations and bottles of expensive wine and, all the things you can buy for these suits. It's great. That's what you're into.
The fund's operating expenses.
That's the yacht for the CEO right there.
And taxes. Let's start with the investment management fee. In our example, the management fee is 60 basis points, or 0.60% per year. 0.6% per year doesn't seem so bad, but
this is only the beginning of the expenses. And also you have to take into account that if you buy an ETF, the fees for an index tracking ETF are, for example, some of them are 0.03 to 0.1-ish%. Some of them, the fancier ones, are a little bit more than that. So already you're way behind.
Here. We've used that figure because it's the fee charged on a typical Canadian equity fund from RBC Global Asset Management. A typical fixed income fund fee would be lower. So, what does the investment management fee cover? It pays for professional investment management and research,
A bunch of people you don't know in suits getting rich.
risk management and oversight, the service and support for you and your advisor's
Whatever that means.
firm, and the day-to-day management of the mutual fund company.
You get to pay for their nice office building.
Let's look at the second component of the MER, operating expenses.
That's the operating expenses of the yacht that the CEO owns.
These are typically in the neighborhood of 10 basis points, or 0.10% depending on the fund. Operating expenses include the costs associated with unit holder record keeping and other day-to-day expenses.
Why is this faded into the background? Like, it's just another 0.1% for the CEO's fuel for his yacht. Like, don't worry about it.
Such as accounting and fund valuation, custody, audit and legal services, regulatory filing, and costs of preparing and distributing annual and semi-annual reports and prospectuses.
Emailing you a PDF.
The management fee and operating expenses are subject to tax at a rate that is determined by the tax rate in the provinces where the fund's unit holders live. We've estimated 8 basis points in our example, as HST is generally between 10 and 13%. So, adding up all the components, the
Isn't that fun?
total is 78 basis points, or 0.78% per year. Now, let's look at the MER for Series A. Series A reflects the cost of the fund and includes a fee payable to your advisor for advice and service.
More fees, great.
In this case, the management fee is made up of an investment management fee, which we already discussed, and a trailing commission. Instead of paying your advisor separately, the trailing commission is collected as part of the management fee and paid to your advisor's firm by the fund company. The trailing commission is an ongoing fee paid to your advisor's firm and the financial advisor who provides ongoing financial advice and service.
Ongoing fees are my favorite type of fee.
It's often called the fee for advice. So, what does the fee for advice cover? It can be broken down into 3 components. The first is advice. Your financial advisor provides you expert advice on a variety of matters, like selecting the right investments to meet your needs as you plan for retirement, seek income, or save for life events, building financial plans, tax planning, and monitoring and rebalancing your portfolio, to name just a few. The second
You might be lucky to talk to one of these guys once a year for 5 minutes.
component is access, which covers the infrastructure required by your financial advisor and their firm to support the distribution, sale, and servicing of mutual funds. And the third component is service. Things like trade confirmations, opening and closing accounts, issuing statements, and other client communications and regulatory compliance activities.
The most basic stuff they need to do that any self-directed account or service would do for you.
In our illustration, the trailing commission is 1%, which is a typical percentage for an equity fund.
Ouch.
In general, trailing commissions range from 0.5% to 1%.
0.5% to 1% of your life savings per year.
For an investment of $100,000, a 1% trailing commission would pay your advisor's firm $1,000 for
That's a lot.
the advice and service they provide you. When you add up the management fee, operating expenses, and taxes
And we add all this other stuff. More taxes, blah, blah, blah. Don't worry.
for Series A, the total is 189 basis points.
Oh, oof. 1.89% per year of your total life savings just being ripped away. I mean, that's a lot.
Or 1.89% per year. Let's talk about fees and your returns. It's important to remember when you check how your fund is doing that performance is reported net of the MER.
Yeah, it's important to note this, that they're going to report their performance net of the fees that they charge, because they don't want you to see those fees. They don't want you to see that you had a 6% return for the year, but it could have been 8% if you hadn't been paying all these fees. And they're going to do everything they can to hide it. So it's not going to be very clear on any of these reports how much you're actually paying them.
That means the fund's performance is calculated after the MER is deducted.
So you don't see it. They do that so you can't really see it.
So the returns you see are the returns you actually receive.
What a spin.
As you've learned, there are different fees depending on whether you own Series F or Series A. Remember, Series A will have a higher MER because it includes the trailing commission that pays for advice, access, and service. Series F is used in fee-based accounts, where any fees for advice, access, and service are billed directly by your advisor's firm.
So they're getting you either way.
At RBC Global Asset Management, we offer Series F and Series A to support the different ways that investors and advisors choose to work together. We hope
different ways they choose to rob you.
This introduction to MERs answers most of your questions. If you want to find out more, please.
There's a much better way to play it. It's called an ETF, and I'll do another video on that at some point. But until then, you can do your own research and basically avoid all these fees while getting the exact same returns that you would have gotten otherwise. Them saying they're going to get better returns because they're giving you better advice it's a lie, and it's marketing. It's not true. If that were true, then every single person would be going to RBC to get financial advice because they give the best advice and get the best returns. No, they can't guarantee that. In fact, in all likelihood, they're probably doing worse than the overall market is doing over time, and that's proven. That's been proven through research that actively managed funds typically underperform an ETF or the general stock index. And the funny thing about this is I was looking at the bottom of one of these pages, if I can find it. It was stuff our lawyers, things our lawyers want you to know. This is where you get the real story. And of course, way down at the end, all portfolios have been developed by RBC Investees Incorporated in conjunction with RBC Global Asset Management, an affiliate of RBC Investees. Okay. These portfolios include RBC iShares ETFs. Well, what investment advice am I getting? The advice is buy ETFs. Then, they're not picking individual stocks for you. They're just buying their own brand of ETFs, which they charge fees on. So you get to pay some more fees. So where's the advice? The advice is buy an ETF. Just go buy an ETF on your own. It's very simple to do. I'll do another video on it as well, or search around. There's videos out there and information out there about how to buy an ETF. It's just buy it like a regular stock. Just do that. You will be better off just buying an index tracking ETF than going to the bank and paying these fees over time, over long enough time period. It's basically guaranteed. I can't guarantee anything. Nothing I say is considered financial advice. I'm not a financial advisor. I'm just a person who's sick and tired of these giant corporations taking advantage of people and so transparently. That commercial was gross. I was my blood was boiling watching it on TV. And so I quickly made up this little spreadsheet to kind of demonstrate, based on that 1.98 percent fee that they were talking about per year. Of course, it was 1.98, wasn't it? Let's double check. 1.89. Okay, make sure I got this right. No, I had 1.98. See, you gotta check your numbers. So let me fix this real quick. It'll still be bad. It's not gonna help much, trust me. It'll help some, and it's a good example of why a small percentage change in fees can make a big difference. But see, everybody makes mistakes. Formulas. That should be more. Yes. Okay. So this scenario I have laid out is you're a 25-year-old person. You have a retirement fund. You're starting off. You have $50,000 saved, all theoretical. You might think that's a low number for a 25-year-old. You might think it's a high number. It's just a number I kind of picked out of the blue. So the scenario here is you're starting with $50,000, and every year you're contributing another $10,000 to your retirement fund. So it's a pretty healthy amount over 40 years until you're 65. And we're assuming that, on average, I've just done a 5% return overall per year on your investments. That's pretty reasonable over the long term, looking at the general returns of the stock market over time. Some years will be less, some will more, but this is just an example. Now, here's what your retirement fund would look like, this column over time, if you didn't pay any fees. So you'd start with your $50,000, you're contributing $10,000 a year, and you're getting a 5% return every year. So you're making a little bit of money on your investments. And by the time you're 65, you have just over $1.5 million saved. Not bad. The sad part is that's debatably not a lot to retire on in this day and age, but that's just what it came out to. I didn't really think about where I was going to end up. I just made up some numbers to demonstrate this. Now, here's what you'll have if you signed up for this, 1.89% advice and still got a 5% return every year, because that's the most likely scenario, is you still get 1.5 a 5% return per year. So, and I cumulative fees that you've paid over time is here. So you can see over time, instead of $1.5 million, you'll have $900,000 when you're 65, and will have paid $656,000 of fees. So that 1.89% didn't seem like a whole lot, but you can see that over time, if you give your money to the bank and forget about it, this is why they want you in the building. Because if you sign up with them, and the advisor is going to get a nice bonus, I'm sure, if they sign you up, because you're probably worth $656,000 to them. And you might argue now, wait a minute, like math doesn't add up. Like that's more than just the fees would be. No, because I've included in this fee the loss on the gain that you would have made on the fee. So, for example, if you paid $945 in fees, that means you're not making a 5% return on that $945 over the next 40 years. So, is it fair to include that in the fees that the bank is charging you? Yes, I absolutely think it's fair. Because what is the bank doing with that money they took from you? They're investing it, aren't they? So it's money coming out of your pocket and into theirs. So yes, I'm including that in the fees portion, even though it's not directly being paid to them as a fee. It's money going away from you and going to them. So, this is how much you're losing out on, which means it's how much they're gaining at the end of the day. So it's kind of stark. Now, I haven't thought of this before, but what kind of return would the bank need to get on your money in order to actually make their advice worthwhile in this scenario? So this is actually interesting. So let's replace this formula. Let's make it point to this cell 0.05 for our 5% return. And we'll make all of these cells, that one, we're just paying fees in the first year. Oh, you know what? This is this should have been like this, actually. See? Math isn't perfect. It was close. But this first cell, I should be saying that you're making a 5% return in the first year as well. So we'll fix that. 50,000 times. It doesn't matter. It's such a small difference. So we'll make this point to, I'll actually make it 1.05 just so I don't need to do more math. So make this 1.05 point to this cell and make it an absolute reference. And we should still have 903,352 at the end. Formulas. Trying to do this with one hand. It's not as easy. This is bothering me that this is wrong. First year you start with $50,000 and then buy that. Is that right? You pay fees? Maybe you don't pay fees in the first year in this scenario. Doesn't make enough of a difference to fix it. I'm trying to demonstrate a point here anyway, and the point is being made. The math isn't perfect. So we need to make 1.5 million, 1.559997. So at a 5% return, we're only making 903,000. So let's move this up. Let's say double. So let's start with double, 10% return. Will we get there? Oh yeah, easily. You'd think it would be about 2%, right? Because they're charging a 2% fee. 2%, yeah. So at 2%, and then with the compounding, you'd have to even 2.2%, I bet. Oh, even less. 2.1%. Perfect. Close, very close. So they'd have to beat the market by 2.1% over 40 years in order to justify the fees they're charging you. Is that possible? Yes. I can't sit here and say it's not. Is it likely? No. In fact, it's extremely unlikely that over time, the RBC investment advisor will beat the market by an average of 2.1% over 40 years. In all likelihood, they will match the market, and actually more likelihood, they will be slightly below the market. So you're going to end up in this scenario. After 40 years, you trusted RBC, and in a best case, like a good scenario, let's call it, you've lost out on $656,000 that could have been saved for you and your family's retirement. And that's not on a large amount of money. Like realistically, to $1.5 million in 2061, I guarantee you, is not going to be a lot of money. So that's just the way it is. If you can educate yourself about how to invest on your own, how to purchase an ETF portfolio at the very least, which is the most, simple, straightforward, less riskiest thing you can do, then you and your family will be so much better off. And, you don't have to take it from me, but unlike RBC, I don't have huge amounts of money on the line trying to convince you that my way is the best way. I'm just trying to help people out. If this helps one person, inspires them to not go to the bank and figure out how to do this on your own, you can take baby steps. Like if you want to invest a little bit of money with the bank, because that's what you feel comfortable with, and then take some and start trying on your own, that would be a great way to do it too. And then if you start to see, gain confidence in what you're doing, then, you go to the bank and say, hey, I want to move my money out of your accounts and into my own. That would be a great way to do it too. But it's definitely a good idea to start trying to wrap your head around this, even though it's a lot of numbers and it's can be intimidating at first, it's really not that bad. You know, if I can figure it out, I'm sure you can figure it out too. If you want to leave a comment and you have a question about anything like this, how to open an account, what account to use, I will do my best to answer as many as I possibly can. But just, don't want people to get taken. That's basically it.